As widely expected, the Bank of Korea opted for another rate freeze for the country's interest rate on Tuesday. That means the central bank could be one step closer to ending its vicious rate hike cycle. But is that really the case? And if so, what's next? For more, we're joined by Professor Song Soo-young from Chung-Ang University. Welcome to the program.
Yeah, good morning to you, and thank you for inviting me.
Thanks for joining us. The central bank named inflation forecasts above the target level and financial risks broadening in major countries for its latest rate freeze decision. Professor, is that so? I mean, what other factors played a role in keeping the rate at 3.5%?
Yeah, Chairman of Bank of Korea has mentioned that the turmoil which has been reverberated around the world in the U.S. and in the European international bank, investment bank, such as Credit Suisse. However, that is just a reason that is proposed as a financial sector's problem. However, in Korean domestic economy has suffered so much from some upcoming recess. I believe that Korean economy is now in the recess, or just starting of the recess, because of the recently the turmoil in the short-term corporate bonds market, such as commercial papers market has suffered so much from the sudden freeze of the guarantee by some municipal government in the last October and September. So currently, Korea's economic problem is not just a problem from the abroad, but domestic problem is more severe than the problems from originated from the foreign financial market. So the consecutive freeze is very welcome, and also it would be a little bit more the prospect, as long as the prospect is not good. So I'm thinking about some reducing rather than hiking. Rather than interest hike, the reducing interest rate should be under consideration.
Sure. So the central bank focusing more on the domestic problems and challenges at the moment. And on top of the rate freeze yesterday, the BOK also said the country's economic growth outlook for this year will fall slightly below the February forecast, which is 1.6%. Now, Professor, what does that mean? Does it mean soaring consumer prices are no longer the top priority?
I agree with that. And rather than worrying about because consumer price index and the producer price index is 4.8%, and the consumer price index is 4.5 or 6%. So clearly the inflation shows some declining, but however, the economic growth and the domestic economy is really a problem. The growth rate has been, this morning the IMF just, the outlook for the South Korean economic growth rate is 1.5%, reduced from 1.7%. So even worse than the Bank of Korea's outlook. So to that regard, we've first to focus on not only the problem of the negative area of balance of trade, deficit of balance of trade, and also the very weak economic activities within domestic market. That is really a serious threat.
Right. And at the same time, the central bank policymakers have left the door open for a quarter-point hike, whereas there are some market voices saying that there may be a rate cut as early as in the latter half of the year. Now, Professor, what's your point of view?
I think that is somewhat like don't expect too much about rate reduction in the future. So they are concerned about some boom, the unexpected boom from the real estate market because of expecting the lower interest rate, basic interest rate. So, but it's like a threat without any meaningful intention at all. So that is just exaggeration, I think.
Right, we'll have to wait and see. Now, the interest rate difference between South Korea and the U.S. stands at 1.5 percentage points. That's already the widest gap in around 2 decades. Now, if the Fed does push ahead with another rate hike, widening the gap, what will that mean for South Korea and the market?
Yeah, currently we have 1.5% difference or interest rate gap between U.S. and Korea. But however, it's quite a long period since we have been decoupled from each other because of the exchange rate is largely affected not by the interest rate level, but by some purchasing power or domestic economy and the prospect of growth rate. I think those parts plays more role than the interest rate. So that means as long as the prospect is good, then the dollars and the foreign investment will come into South Korea. Otherwise, it will flow out. In U.S., the problem is even though U.S. has a prospect is a little bit good, as long as the only domestic economy is good, does not necessarily mean it produces a very financial profit to the international financial investors. So as long as the issues of future prospect and profitability depends upon both the domestic economy of U.S. and abroad, then the stock market response is always affected by whether the prospect of the U.S. economy is good or not, and also the available financial fund that is affected by the interest rate. At least the U.S. maintains some interest rate very high to keep the inflation under control. But whereas for South Korea, we don't have to worry about those interest rate gap, and then we do not pay attention to the exchange rate. So as long as the depreciation of Korean currency would be of help to the improving the balance of trade for South Korea.
Right. All right, Professor Song, thank you so much for joining us this morning. Have a lovely day.
Yeah, thank you too.